So the question of the day, the question I keep getting asked right now is, should I wait until the market goes down before I buy a house? Well, there are multiple sides to every debate. The bottom line is you have to decide how much you're willing to risk. It's important to remember that many factors go into the price of a home. Things like interest rates, things like time of year and seasonality, things like the economy in any particular market or area. It's more than just about predicting when a crash is going to happen. Some industry experts say that the fluctuation in prices depends on the needs and goals of a particular area, and they're referring to a particular geographic area. The J.P. Morgan Private Bank 2022 analysis of 116 metropolitan areas predicts that they're predicting housing prices are going to go in one of three directions, in general directions, over the next couple of years. In some areas, they're predicting drops of 20 to 30%. In some areas, they're predicting drops of 10 to 15%. And in other areas, they're predicting no drop in prices at all. Other experts say that trying to time the market is a fool's errand. There's a saying out there that you don't day trade your house. The market changes very quickly, and many experts are convinced that the best time to buy is when it's a good time to buy for you. Take into account what you need, what your family needs, where you are in your life. There's another saying, and you're hearing it a lot right now with interest rates up, that say, marry the house and date the rate. So the way you want to think about that, when interest rates were really low at 2 and 3%, and you were looking at a $400,000 house, you probably had to pay $450 or $475 for that house because there were so many buyers in the market. So you paid more overall for the house, even though you had a lower interest rate. Well, now you as a buyer, you have a lot more time to think about a house because interest rates are high. Although at the time of this filming, they just went from 7.25% down to 6.25%. And so you may have more leverage. You're looking at a $400,000 house, but there's less buyers out there. There's less buyers that have affordability at that higher interest rate. So you may even get the house for less, meaning that even if you're paying a higher interest rate overall, you're getting the house for less money and possibly even paying less on a monthly basis. The third thing to notice about this is that Robert Dietz, the chief economist of the National Association of Home Builders, and this is home builders, says, I think you want to be strategic and patient. Patience is different from waiting for a crash. That really does sum it all up. It's good to take the time to do your research and figure out your strategy. And buyers have more time now to think about the house. They don't have to pick the house that they can get. They can go out and look at a couple houses. Now in our area, which is New England, Rhode Island, particularly at Quinnick Island, we are still seeing multiple offers on a well-priced, put together home. But in other occasions, we're seeing a lot more drops in price than we've seen before, and we're often able to negotiate off that asking price. So rather than sitting around and waiting for the market to crash when there are no indicators that that's going to happen, why not think about what you need and go after the house that you need? I'm SandiWarner with Warner Realty Group, making the complex simple.